Welcome to the Pulse Check podcast. We have a special episode today focusing on 2025 highlights. We've had a packed year looking at developments in banking and insurance with also fintech, insurtech companies. So let's dive in. Before we talk about the everyday person, can you maybe describe in your words and maybe also in the context of Odex what banking as a service means?
Well, I think if you ask 20 people in financial services what the definition of banking as a service is, essentially you get 20 different definitions. I think that there is a long standing debate around this. So in my mind, the definition is quite simple. I think banking as a service is a distribution play, not just for banking products, but also banking capabilities such as onboarding a KYC, a customer, and fraud detection, and so on and so forth. And exposing these capabilities and products, loans, deposits, wealth, to non-financial institutions and getting them embedded into their ecosystems. The interesting bit about the term banking as a service is that there are different ways of executing it, right? So in the US, there is a technology intermediary between the bank and the ecosystem on the front end, mostly unlicensed, significant risks of fraud and operational. In Europe, you get a slightly different spin on that, whereby you have a technology intermediary, but most of them are licensed, they're payments provider on some P2P licensing. Even then, there are some risks, but they are slightly better in terms of the way they ensure reconciliation of data as well as payment terms. In Asia, generally, you see a lot more where banks provide banking as a service directly with technology players embedded inside the bank, meaning people like Odex, right, for example, create a platform and allows for bank to use that platform for scalability, instantaneous movements, modernization, no downtime, and allows for you to hit large ecosystems of hundreds of millions of players or users, and therefore run, significant concurrent scale.
So the fintech in Western markets tends to focus on a very narrow definition and looks at a function or a feature, and it tries to innovate that function and feature, and then you add it on. In China, it's very different. It's much more embracing of a customer experience, and you don't have those industry boundaries. So the innovations in the fintech scene in China are a lot more holistic. They surround the customer, and they do a lot more than what the fintech innovations that are happening in Western markets.
I mean, in China, innovation is very practical. So already 10 years ago, when you went to small little shops in China somewhere outside in way on rural areas, you could go and see a few things you want to buy, and then you realize, can I now pay with credit card? I have not enough cash, and then there's just a QR code, right? I mean, there was a standard already 10 years ago, which is not even in Switzerland fully applied.
Most Western banks protect data, and they do a very good job at protecting data. What they don't do is they leverage that data. And I think that's the next decade we're going to see banks start to utilize what they have. And that really comes back to, well, what is banking? And people think, it's financial services, it's giving mortgages and everything. No, it is about creating opportunity for people, opportunity for businesses, opportunity for the country. So it is the movement of capital.
What are some of the main challenges you see in the really incumbent traditional banks if you want to really modernize, digitize?
There is a big mismatch of costs and subsequent revenue and profit in banking. So a lot of the costs go in first, and then you make money over time once you have kind of perfected the model, especially the retail side. A business of just sheer demographics. And it's a local business, it's not a global business. So when people talk about building a global bank, there are, in my opinion, going to be very few global banks, because after the global financial crisis, it was recognized that one of the dangers of that model was that capital was not locked necessarily in a country where you had a big presence, and that's important because if a bank fails, then you need to figure out how you're going to pay the depositors. And so capital was no longer freely mobile. Regulatory scrutiny increased. And as a result of that, the profitability of banking on a global basis, in fact, it calls into question whether retail banking is even a global business, because it's fundamentally very local compared to the likes of Google, Facebook, Airbnb. And people often forget that those businesses are pure software, and software transcends borders quite easily, and that's why they have not unusually a 40x PE ratio. So I think a lot of people don't understand those fundamentals about banking, and when you add those fundamentals into banking, then you find that it's not what it appears to be on the surface. Because on the surface, a lot of startups think that it's a technology business that needs to understand risk, but I think it's a risk business that needs to that uses a lot of technology.
I do believe that customers notice, differentiating offerings from a usage perspective. So if you have your mobile application, you can do what you need to do there, then that's definitely a big plus. And I think also, especially if you go into wealth services, where it's not just payments and simple transactions, but you actually want to get access to the expertise that the wealth manager also offers. There, what has also become a lot more important over the past couple of years is a proper omni-channel experience, so that you can choose yourself. What do you want to try yourself? What do you want to do yourself? And then at the point of time where you need help, or where you want to get input from a relationship manager, that's where you get in touch, and you don't need to start from scratch, but they can basically progress where you left off on your own.
The worst feeling as a customer, at least for me personally, is if you feel that you're immediately put into buckets with the typical client segmentation banks undertake. And of course, people are actually not just in one bucket. Even high net worth, ultra high net worth individuals are also retail customer to some extent. They also need a credit card and so on. And you may also have your business, or you're also a business banking customer.
The reality today is that the dominant model is still you segment your customers based on AUM. So how much money do they have with your bank? And that's how you segment your customers. And that's also then how you assign your value proposition. So as a retail customer, these are the products that you get. These are the services that you get. As an affluent customer, this is what you get. You get a package. And then as a private banking customer, the reality is that, as you say, every private banking customer is also a retail customer somewhere, right? They also have credit cards. They also need to pay their bills. So they also need basic payment services, etc. And I think this is where universal banks have a significant opportunity.
In Hong Kong, we have 8 virtual banks that launch, and they also target customers quickly with very interesting interest programs. But then over time, they struggle to become really profitable and as such successful. They're still working on that, and some of them will come close soon. But how is it for Chocolate Finance specifically?
Yeah, look, I think first and foremost, Chocolate Finance is not a bank. We're an asset management company, but what we do is we use more up-to-date technologies and asset management techniques to be able to provide services that help customers with their cash management at a higher level of yield. And we can do that because we're not a bank, and because we've completely and fundamentally differently structured. The difference really between us as Chocolate Finance or a bank or an insurance company is that a customer's money with a bank or an insurance company goes onto the bank's balance sheet or the insurance company's balance sheet. It's an asset of the insurance company, and your policy or bank account is a liability of the bank or insurance company, right? But with an asset manager, it doesn't work that way. Your assets are actually held in a separately ring-fenced, segregated, custodized account. It's not part of Chocolate's assets, it's the customer's assets, right? We just manage it on behalf of the customer. So what Chocolate Finance has really done is taken this idea of how can we use the core backbone of how investable assets can generate yield and package that up in a way that delivers daily liquidity, daily returns, instant access, and all of the cool stuff that you'd expect from how money management works.
I would love to start with a bit of a backward-looking view on where wealth tech was, and you mentioned before advisory, discretionary portfolio management. Maybe you can also then quickly say a few words on how this may also differentiate in Asia, especially Hong Kong versus Europe, why there was maybe also a niche to play, and how it evolved in the past 15 years.
Absolutely. So, we generally differentiate between two wealth management processes or products. The one is advisory, where you basically go to a client, you recommend him a trade. You're saying, buy IBM or buy the structured product or sell this. And you make the money from the commission of that transaction. And on the other hand side, you've got what's called discretionary, which is more like an asset management mandate. The client says, well, here's a pot of money. These are my preferences. This is the investment manager strategies I prefer, but you manage it for me. And what you've seen in Europe, discretionary was always a much larger portion of the mix. And with the regulatory changes like MiFID II, it became so expensive to do advisory because for every trade you had to write this essay of why you recommended it and why this is good for the client and which alternatives you considered. And that got introduced already quite a long time ago. So back then you didn't have Gen AI to write this for you. So it basically meant that the whole market moved into discretionary. There's another reason though why in Europe this is also the more palatable product. And the reason is that generation of wealth transfer happened much earlier than in Asia. In Asia, most of the wealth is much newer than what it is in Europe. Now, the first generation, and especially in Asia, they are mostly entrepreneurs, and they are used to make all these decisions themselves. And you became a successful entrepreneur by making the right decisions many, many times. So you naturally assume you're going to make the right decisions on investment products.
The first initial idea when we started Planto back in 2018 was really around the idea of, helping millennials who we thought were an underserved segment at that point, and providing them all the kind of, financial insights, all the kind of tips and the guidance to help them, move towards their financial journey. One of the personal kind of inspiration behind this, launching this company was that I remember, calling up a bank when I was still working at HSBC, and I said, "Look, you know what? I work in a bank. I think I make a little bit of money, so I need some guidance on how I can invest that money." And the kind of answer I got was, "You're not rich enough for us." And so I think what that kind of told me was that. And what that made me question was I might not be wealthy enough today, but then I think I'm on my way to have a decent career ahead of me, and I might be a valuable customer to you today. So why do you want to miss the chance to serve me right now?
For sure, right? As a Planto co-founder, once it's a multi-billion-dollar company, they might come back.
The fact that, I'm not able to get that guidance from a financial institution around helping me manage my finances, it means a lot of my friends are probably not getting it as well. And so that's where, me and my co-founders, we kind of came along with this idea that let's provide that guidance and sort of, insights to the customer, to people in an extremely easy, digital kind of way. And so that's where we actually launched an app in the market which basically help consumers kind of link all their bank accounts, all their credit cards, investment accounts. In Hong Kong, we have the MPF accounts, which is kind of like the retirement portfolio accounts, so that customers can see all their finances in one place and, can get sort of a lot of personalized insights on how they are doing. We were over 300,000 registered users on the app in a place like Hong Kong, which is about sort of 5.5 million digitally active customers.
When it comes to fintech, differences you see from Europe, Switzerland, where you even had your own Internet of Things startup, while now here supporting startups in Asia. Do you see some bigger cultural differences?
The challenges that startups are tackling are different, because especially in the fintech space here, we definitely have a lot of unbanked, underbanked, underinsured populations, and I think that's really where the opportunity lies, for example, in APAC, whereas in Europe is obviously a more developed market in that sense, and you might have a lot more B2B focused solutions or other use cases that might not be so dominant or that are really different to what we are seeing in Asia.
Brings me to the question on also how best can big corporates work with fintech and not see them only as a threat, but also really as partners, and maybe also how you help and facilitate the partnership and conversation.
Most of the startups are completely disrupting the established players. I think it is more about augmentation. That's really what we are seeing. I think there, as a startup, you can innovate much faster. You can fail. You can pivot. Whereas for a corporate, to really try new things is always relatively difficult, and decisions take longer, etc. So that's really where the opportunity lies for corporates to experiment, to see what works, what doesn't work, and instead of just building it themselves, they can work with a startup, and that's really where we come in. We facilitate that.
How can we make it a really more passionate, better experience for customers? So tell us a bit about the proposition, maybe, from product to experience.
So, I mean, like what you said, right? Like, you buy a car, then you realize you have to buy insurance, right? I think you're probably more excited about buying the car, right?
Yes.
Like, you wake up in the morning, you go, okay, I'm going to go and shop for a car, versus, I'm going to go and buy, insurance, right? Insurance, it feels like a bit of a grudge purchase, right? Okay, I need it, so I have to buy it. But when you think about it more deeply, it's actually a hugely emotional purchase, especially in the context of like life insurance and health insurance. Because I see insurance as something that it's like an offering to improve life experiences of someone at moments that matter and for things that really matter. But, I think the way is been historically packaged, and how it's really quite complicated, right? It just comes across as it's a bit boring. It's a bit of a drag to go and buy something that is actually so important to you. I think what's really necessary now is to really reframe the way we look at how insurance is as not just a product construct, right? It really is an experience, right? So customer experience is not something that's over there. Okay, we have this insurance product, the policy, the product construct, and over there somehow we'll apply some customer experience magic, right, to make it more easy to buy. I don't think that's the point. The point is the category itself is experiential, right? A policy, what can you really do with a policy? Put it in your drawer, or we've put it in your, I guess, iCloud. Nowadays, everything is digital. But it shouldn't be like that. And it requires a mindset shift, right, for companies to think about how they need to develop a solution, right, for their customers.
So I would love to start with a bit of the digitization of the healthcare ecosystem. What is the state today, but also where does it go? Where do you see developments?
Yeah, I think the healthcare ecosystem across the region is developing rapidly. I think that the pace of that change has, never been faster, particularly with new technologies arriving, artificial intelligence, generative AI, agentic AI, where you've actually got applications that are going to be collaborating with each other with very little human interaction. All that sort of is quite progressive, but I think as an industry, as a healthcare industry, we're actually not quite, a long way from that just yet. I think even the foundations around digitalization of data warehouse or data structures, collating data, a lot of the work, particularly not just in Hong Kong, but across the region, is still quite paper-based. Mm. And I think that challenge to digitize even the most core of systems, the core of processes, is still underway, and organizations are still working through that journey. Now, the bigger players, of course, that I've worked with, the top 3 life, accident, and health insurers across the region, they're a little more progressed than others, but still quite a long way from where they want to be. There's a global trend of becoming, not just a payer, but a partner in health, and to do that, digital is the way to do that at scale. And helping organizations on their transformation journey is one of the reasons why I'm collaborating with SynPulse, working with you guys to sort of help organizations address these challenges. But definitely a long way to go. I think the role of data and analytics generally, is still nascent. I think there's some more advanced markets than others. But the big challenge has been around structuring data. I think with AI now, you maybe need less structured data. AI can actually work through your various databases and actually collate information as needed. And I think that's going to be a game changer in terms of both service delivery, operational efficiency, customer experience, and innovation around products and policies that where we can cover new patients and new segments.
Also, my experience when I came to Hong Kong more than 10 years ago is that I was expecting, okay, I go online, I can quickly check different health insurance with the different benefits and compare and select and do it all online. And was then immediately reminded, no, you need to talk to either brokers or different agents. So why do you think is there not more digital?
If you look at the journey of many insurers, it's not as if they haven't embraced technology and they haven't thought about new innovation in order to help their customer or their distribution base. But in reality, for the years of building insurance business, whether it's in life, whether it's in P&C, whether it's in group, frankly, they are partnership businesses, whether that's partnerships with the agency force they create, the broker force that they do have multi-distribution with, or even now in the world of embedded insurance, thinking about how they penetrate and work with new digital business models. That's where they're much more comfortable in terms of thinking about how they actually grow their business. For many people, it's about, well, shouldn't it be the digitization focus on the end customer, the policyholder? 100%. Insurers do try to simplify that journey, but in many ways, they realize the way to get to the customer is actually through that partnership network. And all realism, what the insurers have realized is that has been the way of how they've been able to distribute the product, which, as mentioned, tends to be relatively complex. And then it's that complexity which then drives higher margins and higher sort of profitability. And thus having that sort of partner sort of growth game plan is the way they've scaled their businesses.
That's a wrap for part 1 with the year-end highlights. This is not done yet. We go with part 2 coming up soon with more insights and standout moments in 25. Stay tuned.